What's going on? Welcome back. Ryan here. In this video, we are talking about call credit spreads and put credit spreads. This is one side of the vertical spreads. And again, these are some of my favorite trades because you can control the risk and you can create income based on your schedule, what you like with your risk tolerances, right? So again, we'll look at Apple, for example. And all right, so we got Apple. And so what are credit spreads? Well, call credit spreads, put credit spreads are exactly that. It's a combination where you're buying a call, right? You're selling a call, you're buying a call, or you're selling a put and you're buying a put, in a combination that you take in a net credit. And so, for instance, if we're looking at Apple and we think Apple is going to go up, we'll come into here, 30 days out, and we think Apple is going to go up, right? So here the strikes are getting bigger this way. So we think that Apple is moving up. And so what we could do is we could sell a put credit spread. So what does that mean, right? Well, if we come down here and we did a 5-point spread where we're selling this 170 strike, so I'm control clicking here and I'm selling this 170, and then I come in here and again I control click and I buy the 165, right? So I'm selling the more expensive put that's closer to the money, and I'm buying the less expensive put 5 points away beneath the market as insurance, right? This is a 5-point spread, and we can see that maybe we could do this for $1.60 credit, right? And when we look at a one lot, again, this is a 5-point spread, so we're risking $340 or $3.40 to make $1.60 or 160, right? So again, let's kind of look at this math, right? This is a 5-point spread. We're getting $1.60 credit, right? So a 5-point spread minus our $1.60 credit gives us $3.40 of risk times 100 shares. It's $340 of risk, right? So when we analyze this trade, we're going to get a graph that looks like this, right? Where defined risk, right? Bullish strategy, right? Where the numbers are getting bigger this way. So if Apple continues to go up, or even if it stays where it is, right? As the time passes, this purple line, our time value line, approaches this blue line, which is the intrinsic value at expiration, right? So again, these are really, really powerful. This can create income every day, right? Because of the passage of time, because we're using theta decay to our advantage, right? So as time progresses, these will decay away, and now you can see that this is making money, right? If we close this out, we would get $113.03. And this is a trade that you can use all the time, every day, forever, right? You can come in here, you can pick out your risk, and you can sell these credit spreads, okay? So on the other side of this, right? So first we did the put credit spread, right? Where what we're doing is for instance, we sold, what did we do? So we sold the 170 and we bought the 165, right? So if we come in here to 170, right? Here's this 170 basically, and then again, right, we come in here and we buy that 165, right? So think about this conceptually, right? Where when we look at this, we're selling this option closer to the money. We're buying this option farther away from the money, right? Where if the market tanks, we're covered and there's no risk. It's only defined risk to the downside, right? Which is the difference in this spread and the credit we received, right? So if Apple continues up, both of these expire and we keep the credit that we sold this credit spread for, right? So that would be the put credit spread, okay? And on the other side, if we thought Apple was going to go down and we thought that Apple was not going to break out of this one standard deviation, not try to continue this trend, right? Maybe trade sideways. Well, again, we could come in here and we could do the same thing, right? Maybe we want to be a little bit farther away from the money to have a little bit more cushion. But remember, we would be selling the option closer to the money, right? So we'll sell this 180 strike call. And then what we'll do is we'll buy this 185 strike call above it. And again, this is going to give us a credit, right? If we put this bid-ask spread in the middle, right, this would give us a credit of $1.20, right? Which then is, we're risking $3.80 per contract or $380, right? So we would lose $380 if Apple continued up, and we would keep our $120 credit if Apple stays where it is or it continues to move down. Now, one of the most important things that you're going to learn about credit spreads is, number one, where is the risk? And number two, how do we control that risk? And I'm going to tell you right now exactly how this works. So pay attention. When we're dealing with credit spreads, right, as we saw before, with the put credit spread, we sold the 170, we bought the 165. On the call side, as the example, we sold the 180 and we bought the 185. It's important to understand that the closer you sell credit spreads to the money, the better the risk reward is going to be. Okay, now let me give you an example of this. We'll move to, let's do 58 days out, and we'll actually go out of the money. We'll do like a 10 delta, right? So the delta of minus 11 is basically saying this has an 11% chance of ending up in the money, or we have a 90% chance of this not ending in the money and we keep our credit spread. Okay, so again, I'm selling this 145 strike put and I will do a 5-point spread where I buy the 140. But now look, again, it's a 5-point spread, but because I'm so far away from the money, I'm only getting a 39-cent credit, right? Which turns out when we're looking, when we're looking at a one lot here on a 5-point spread, we're risking $461 to make $39. Now, when we do the math on that, right, if we take $461 of risk, we take $39 of potential profit divided by the $461 of risk times 100%, that gives us, approximately 8.46% of potential return on our cash, which is not bad if we were to do this 3 times a week, right? You make 8% on your credit spread on your cash 3 times a week or once a month, whatever it may be. But for the sake of this example, what I'm trying to show you here is the farther away from at the money we sell this credit spread, the higher the probability of us winning is going to be, but the worse the risk to reward is going to be. Okay, So let's analyze this trade and actually see what this looks like. So here's the credit spread, 10 delta, right, where we're risking 461 to make 39 bucks. Or if we did a 10 lot on this, we would be risking $4,610 to make 390 bucks. Okay, now if we start to sell closer to the money and even in the money, this is where we get the best risk to reward. So for example, when we're looking at Apple, this looks pretty bullish to me, right? Apple is in an uptrend. It came up here and traded above this 3 standard deviation. It reverted back to the mean. Now we have this bullish candle, right, where it came down, it touched its mean, and now it has still traded up, and it's possible and probable that Apple will continue this uptrend. So remember, when we looked at the risk out of the money selling a 10 delta option put credit spread, right, we're not having great risk to reward. Now, if we still believe that Apple is bullish, as an example, let's see what happens when we sell in the money credit spread. So take this for example. The 180 put here in the money, we're going to sell this, okay? And then we're going to buy the option right below it, which again is a 5-point spread. But now look at what's happening. We're getting a much larger credit, which is actually, this is the type of trades that I like to take, right? Because now when we look at this risk to reward, we're actually getting a really good deal here, right? We're risking $215 to make $285, right? So when we actually analyze this trade, right? So again, here is the 10 delta out of the money put credit spread, right? And now when we look at the credit spread we sold in the money, look at the risk to reward here, right? We're only risking $215 to make $285, right? This risk to reward is much better. But some people could say that there's more risk, right? In the sense that when we look at this option chain, for this spread to make money, Apple is definitely going to need to go up at least enough to where Apple is above this 180 strike, which is the short option we sold. Okay, so really important to understand vertical spreads, credit spreads, right? And just exactly, how we control that risk, what it means to sell out of the money versus selling more in the money. And again, I want to present a scenario that could be very high probability for traders looking to make consistent income. And that situation looks something like this. So when Apple is, as I said before, right? Securities, stocks, all these different assets, a lot of the time they're trending and they're going up or they're going down. And at other times they're trading sideways. And there are situations, right, where it trades up out of this 3 standard deviation, right, which doesn't happen all the time. And usually what happens is once it does, it starts to revert back to the mean. And these are the situations where it can be profitable to sell credit spreads, right? Where the market makes a move up and then we sell that at the money credit spread in the money for a 1-to-1 risk to reward. And when the security reverts back to its mean, we keep the profit on that credit spread. Okay? Now, it's very important to be able to tell the difference when a market is trending and when it's trading sideways, right? Again, if we just come here and look at this example, right here, this market is trading sideways and then it comes into this volatility squeeze. Here it makes that move out of the volatility squeeze. And when we lose momentum as we come into this 3 standard deviation range here, we could then sell an at the money call credit spread, right? Where so far, when we've looked at this, these are put credit spreads, right? We have the put credit spread where we sold 10 delta. That gives us this horrible risk to reward ratio, right? Then we sold the in the money put credit spread where we have much better risk to reward ratio. And if we wanted to come in here and do the opposite of this trade on the call side, right? Again, remember, if we're selling, these, let's look for the 10 deltas again. So here's delta, here's a 10 delta. So we're going to sell this 10 delta and we're going to buy, we're selling the 205 strike 10 delta and we're buying the 210 strike call, right? And again, the risk to reward on this is not going to be good, right? So again, this call credit spread is a bearish sentiment strategy, right? When we look at the chart, we're selling a call credit spread, for instance, and we're wanting the asset to go down, right? So this is an example of that. And now, again, when we look at selling at the money or closer into the money, let's, for instance, if we sell the 165 call and we buy the 170 call, both of them are in the money. We just get such better risk to reward for these trades, right? So look at this. We could get a $3 credit almost on this possibly, right? Where now look at the risk to reward on this, right? We're risking $200 to make $300, right? And if it's highly probable that a security, right, is going to revert back to its mean, this is a very high probability setup to make money with the passage of time by putting on these credit spreads, okay? So again, as we're looking at Apple as an example, right? We first did this put credit spread out of the money 10 delta. Then we sold the put credit spread in the money, right, where we had much better risk to reward. And selling the put credit spreads is a bullish sentiment strategy, right? We're wanting the underlying security to either go up or to go up and sideways. And on the other side of that is the call credit spread. Again, selling the call credit spread way out of the money with really not great risk to reward, as opposed to selling the in the money call credit spread, right, where we're getting much better risk to reward. Now, there's a lot of things that you can do with credit spreads, right? You can finance trades where you put this credit spread on in anticipation that it's going to win, and then you use this credit to then go buy other options, right? There's a lot of different things we can do. The most important thing is understanding how we control the risk, which is based on how close or far away from the money we sell these. And finally, we're going to talk about how you get in trouble with these credit spreads. Okay, so what I'm going to do is I'm going to delete the credit spreads that had the bad risk and reward, right? So now we only have this put credit spread and this call credit spread, right? And you're going to get in trouble with call credit spreads when you hold them to expiration and the underlying security settles between the strikes, okay? So I'm going to show this to you visually, how we can lose money and what you want to avoid, right? So if we look at the example we did before, right, of this put credit spread where we sold we sold the 180 put and we bought the 175 put for a $2.85 credit, right? So 180, 175. So here's basically 180, and then here is basically 175, right? So again, we sold this in the money put credit spread, anticipating Apple moving above this, where both of these expire worthless. And now what we do is we keep that credit. Now, what I'm trying to say is the risk to losing money on this, and I'm not sure if anybody heard the scenario of this Robinhood trader who, very, very sad, he ended up taking his own life because he was selling credit spreads, and for whatever reason, whether it was an error on Robinhood or it was the settling amounts of having so much leverage, right? Selling hundreds of these, for whatever reason, maybe Apple or whatever he was trading settled in between these strikes, where now you potentially have assignment or exercise risk, where now you have tons of leverage and you have to take delivery. And this is where you could get in trouble. So think about this. If we're short the 180 put and we're long the 175 put, well, if Apple goes down and both of these are in the money, then we're going to lose the maximum amount on this spread, which would be $215, right? If Apple stays below here, we're going to lose that $215, and that's fine. Okay, well, that'll be a loser, whatever. But the trouble can arise where you have this scenario where Apple goes up here and now it's between these strikes, right? Remember, if Apple closes above both of these, they're both worthless and we keep the entire credit. If Apple is below these, we lose the full amount on the spread, but because they're both in the money, they're going to exercise and you just lose your spread. You get into a lot of trouble when at expiration the security is between these strikes and either you don't have enough margin to manage the trade, which means to exit it, or whatever the scenario is, and then one leg of this credit spread gets either assigned or exercised, right? Whether you're shorter or long. So in this specific example, what would be really, really bad for us would be if we held this credit spread until expiration, and now Apple is trading in between these, right? And so what would happen here if Apple settles at, because remember, we sold the 180, we bought the 175, right? So if Apple settles at 177 at the day of expiration, what does that mean for us? Well, let's look at this, right? So if Apple were to settle at 177, that would mean that our long put, our 175 long put, right, which is this one, is out of the money, right? So it expires worthless, okay? But this 180, right, our short strike is in the money, right? And because we sold this put, we would then be long. We would be long 100 shares of Apple, or however many contracts we sold, right? So this is where people can get in trouble, right? Because people want to make money quickly, they want to make a lot, so they leverage up and they sell lots of these credit spreads, maybe 5, 10, 20 of them, whatever it may be. And then they get into trouble when the asset settles between them and one side, one leg of this credit spread gets assigned, right? So think about it. If it settles at 177, your long 175 put is out of the money, but your short put is in the money, and now you are long however many contracts of leverage you use. You're going to be long those shares from $180. And if it's at 177 between these strikes, that means that you're already down $3 of intrinsic value on those shares. And this is where you can either get lucky and it works out in your favor, or you can get very unlucky and you can lose a lot of money, right? So imagine it settles between, right? The long side is out of the money, but the short side is in the money, and now you're assigned, right? Because the options you sold are automatically assigned if it's in the money, and now you're long Apple at $180. Well, if Apple turns around from where you were just assigned, and Apple just decides to tank, right? You can potentially lose a lot of money, and all depending on how much leverage you use, right? The other scenario where you would get quite lucky is if you're assigned on those short puts, right? So you're long the stock, and instead of it turning around and losing value, now Apple starts to rally and you're long those shares and you end up making money from the assignment, right? So you could tell that this could be a very dicey scenario, which is why I recommend for beginning traders, right? If you're starting to trade credit spreads, call credit spreads, put credit spreads, do it in a way where you don't have to worry about this assignment, right? It's just one more area of risk that can get you into trouble, and it's not really necessary, right? Because when we're looking at trading credit spreads, right, I tend to like selling credit spreads with at least 1 to 2 weeks of time. I don't quite like selling credit spreads with less than a week of time, just because of this scenario of risking assignment, right? If the underlying settles between these strikes. Okay, so again, I love talking about options. I love thinking about all the ways that we can use this to our advantage, and there's so many. But again, when we're looking at the different strategies, particularly, credit spreads, or when we're using spreads, it's so important to understand the risk, right? The risk is not just what we're seeing here when we look at this, right? The real risk is when this underlying asset settles between these strikes and you risk assignment on one side of this trade. And then after that happens, the market can do whatever it's going to do, and you will be responsible for all of this leverage, for all of the shares or futures or whatever it is that you get assigned. Okay, so really important to, number one, understand the credit spreads, understand how to control the risk by either selling in the money or more out of the money, and then understanding where we lose, which is obviously, depending on where the asset goes and what happens, but mostly being aware of expiration and understanding the real risk of assignment when the underlying settles between your strikes. Okay, I can't stress this enough. This is super important. Once you understand this, once you get how this works, you can really do a lot of damage when you're using these credit spreads, because they can be so lucrative when you know what you're doing and how to do it correctly. Okay, so again, reach out to me if you have any questions. And as always, I look forward to talking in the next video.